This is forex trading for beginners. So what we have to do, we have to first of all know the meaning of forex. First of all, know the meaning of forex. This forex we are hearing about, talking about, what is the meaning of forex? So forex means foreign exchange. So the FOR means foreign. Foreign. Why the EOX means exchange? See, the word forex means foreign exchange. That's the full meaning of forex trading. It means foreign exchange. See, so what is the meaning of forex? Forex is the art of buying and selling currency pairs. So the art of buying and selling currency pairs is called forex. So we'll talk about the basics of forex trading that we have. Okay, let me delete this. Let's talk about the basics of forex trading that we have. Basics of forex. Basics of forex trading. So the basics of forex trading, we have the currency pairs. The currency pairs. We have the currency pairs. Then we have the lot size. We have the lot size, and we have the leverage. We have the leverage, we have take profits, we have stop loss. So I hope you are writing it down, because you need to know all these basics of forex trading. We have take profits, stop loss, we have currency pairs, we have lot size, we have leverage, we have take profit, we have stop loss, and we have time frames. All these are the basics of forex trading. Time frames. The time frame. The time frame. So we have the pips, we have the spread, which is the pips. We have the spread. We have the pips and the spread. So let's end here. So these are the basics of forex trading. These are the basics of forex trading. So I'm going to be taking the one after the other. So we have currency pairs. We have the currency pairs. We have three types of currency pairs. We have the major currency pairs, we have the minor currency pairs, we have the exotic currency pairs. We have the major currency pairs, the minor currency pairs, and the exotic currency pairs. So let me write it out. We have the major, we have the minor, and we have the exotic. We have the major, we have the minor, and we have the exotic currency. So this minor can also be called a cross. also be called a crosses. So these are the three type of currency pairs that we have. Major currency pairs are comprises of developed countries. These are comprises of developed countries like the Euro USD, the GBP USD, the USD JPY, we have the USD CAD. All these are developed countries. They are developed countries. So they are comprises of the major currency pairs. Why the minor currency pairs? These currency pairs, they they are currency pairs that does not include the USD at all. These currency pairs, they don't include the USD at all. So we have the GBP JPY, we have the Euro JPY, we have the Euro GBP, we have the GBP JPY. So all those ones that doesn't include USD, those are the ones that are under crosses or minor pairs. They are under crosses or minor currency pairs. Then we have the exotic currency pairs. These are currency pairs that include one of the major and the undeveloped countries. There's a developing countries like the USD to Nigeria currency, like the USD to Singapore dollar, USD to China. You understand? USD to India rupee. So all those ones are under exotics and their spread are very, very high. So I won't advise you to trade the exotics. So I'll advise you to go for the minor or the major. Mostly of the major if you are new into financial markets, because the major, the spreads are very, 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 very low. They are tight than this and tight than this. So that is why it's advisable to trade the major. You understand? So we have the lot size. We have the lot size. This lot size determines the amount you are using to trade. Understand? So the lot size, it determines the amount you are using to trade. Let's say you are using uh a $10 account. A $10 account, if you're using a 0.01, so depending on the currency pairs you are trading and your lot size and stop loss work hands to hand. So if you want to minimize your risk, you need to get your stop loss. You need to get your stop loss intact with your lot size. Let's say you're using a 0.01 lot size and you are going for a stop loss. There's a stop loss is to limit your losses. YTP is to for your take profits for your target where you're targeting. That is the meaning of TP, where you're targeting to exit the trade, where you're targeting to take your profits. Why stop loss is where you're targeting to exit, that whenever the price gets to this to the exact level, or this psychological area, price is going to exit. See that? So when coming to leverage, this is the amount, the ratio of your capital to the capital the broker borrows you. And these are also work in hand with lot size, work in hand with stop loss. So you need to, if you are a newbie, make use of 0.01. There's 1:100. Make use of 1:100, at least let's say 1:50. Don't go for the unlimited because it will make you, at least if you're using a 1.100, 1:100 and 1:50, is going to allow you the lot size you are going to use is not going to be much than when you increase it to unlimited or 500. So they will give you an account size that they'll give you the lot size that whenever you that you cannot lose your money at once. So there are lot size, there are entries you place, they will tell you I'm not insufficient funds because you have reduced your leverage, reduce the way you risk. So leverage is just reducing the way you risk. You understand? So if you see it, they have the low, they have the medium, and they have the high. So you are not supposed to go for the high when setting up your leverage. At least go for the low. So that when you lose little money. When you lose little money. They won't allow you to use a big lot size that is way bigger than your account. So for that of newbies, use this leverage 1:100 and 1:50. Then we come to the time frame. Time frame is the time given for each of the candlesticks to close. Each of the candlesticks to close. Okay, let's say this is each of these candlesticks you are saying. These are the candlesticks. The green is for the bullish, the red is for the bearish. So each of these candlesticks, the time frame determines if currently I'm using 15 minutes time frame, and this 15 minutes time frame is signifying that of the time, each of the time here, there's each of the candlestick will take about 15 minutes to open and close. Each of the time will take about 15 minutes to open and close to form finish and tell you where the direction of the price is going. So if you're using a 1 hour time frame, each of the candlesticks is 1 hour. It will take 1 hour before it will close. Then we are talking about 2 hours. Each of the candlestick, you have to wait for 2 hours for each candlestick to open and close. If you are going for the 4 hours, you have to be patient enough to wait for candlestick to open and close within 4 hours. You see that? So if you are not that patient kind of person, you can go with 15 minutes. So each candlestick, 15 minutes, you can be able to sit and watch candle of 15 minutes. You understand? So that is it for the time frame. And we have pips. Pips is the fourth decimal point of a currency pair. The fourth decimal point of a currency pair. So if we're having let's say Euro USD. Let's say Euro USD have this piece one ratio. Let's say this is USD. Let's say this is Euro USD quote. Euro USD currency. Okay, let me make you guys to understand. For those of us that don't understand, Euro USD. So let's say it have a quote of 1.1234. So let's say have let's say have a quote of 1.2345. So this 5 year is the pip inside. So after the decimal point, you count 1, 2, 3, 4. So this 5 year is the pip. The 5 is the pip itself. You see that Euro USD, this pips and price move in pips. Price move in pips. If this eventually change to 6, eventually change, it has been changing. There's 5 pips. If you change to 6 pips. If you change to 7 pips. It's moving by pips 1, 2, moving by pips by pips. See that, and we have spread. Spread is the distance between an ask price and a bid price. Let's say this is ask price. It have a color. Let me change the color to ask price. Let's change the color to green, and then the bid price. Sorry, there's the bid price, and this is the ask price. The ask price is always the one below. Uh, let me change the color to red. Let me change the color to red. So the ask price is this. This is the ask price. This is the bid price. This is the bid price. So the distance between this ask price and the bid price here is called spread. The distance, the space between the two of them is called a spread. And you can find this ask price on your MT5 where you want to trade. You see it moving by ask price, bid price. So the spread is the distance between the two of them. So that is the spread there, the distance between the two of them. So hope you guys are grabbing. Hope you're understanding what talking about. Hope you guys are grabbing.